Thank you. Good afternoon. My name is Rich Emery. I'm a professor of accounting here at Linfield. I want to talk to you about globalization and the impact on accounting standards throughout the world. Globalization is a fact of life in today's worldwide economy. Examples abound that we are all familiar with. Nevertheless, it may come as a surprise to realize that as of 2008, of the 500 largest companies in the world, only 153 of them were based in the United States. There are many barriers to achieving a true global market in spite of all this. One of those barriers that probably most people are unaware has to do with accounting standards, or if you will, the presentation of accounting information. Throughout history, companies have issued their accounting standards or their financial statements based on the accounting standards of the country in which they were headquartered. For instance, in the United States, accounting standards are known as GAAP, Generally Accepted Accounting Principles. Before globalization, this was not an issue. However, as companies began operating in different parts of the world, it was necessary to convert financial statements from the home country to the country of operation. Obviously, this conversion process was both time-consuming and costly. As far back as 1973, the professional accounting bodies of several countries, industrialized countries including the United States, came together to form what was called the International Accounting Standards Committee. The objectives of the committee were twofold: to formulate and publish in the public interest standards to be observed in the presentation of financial statements, and to promote worldwide acceptance, to work generally for the improvement and harmonization of regulation, accounting standards, and procedures relating to the presentation of financial statements. The aforementioned countries' accounting bodies are members of the International Federation of Accountants, which by 1997 had 119 members from 88 countries. The IASC evolved into the IASB, International Accounting Standards Board, which was responsible for establishing what are referred to as International Financial Reporting Standards. International Financial Reporting Standards are the standards that are accepted by most of the rest of the industrialized world. For example, in June of 2002, the Council of Ministers of the European Union indicated that as of January 1, 2005, all EU countries would have to adopt IFRS. Since then, other countries have followed suit, such as Canada, India, Korea, Brazil, etc. As of this point, the United States has not agreed to move toward IFRS. However, they have indicated, the U.S. has indicated that they will move, or at least take under discussion, moving from U.S. GAAP to IFRS. The question remains twofold. Number one, will this occur? If so, when? And thirdly, what will we end up with? There are several issues that the United States has balked about in moving to IFRS. The most important of those issues is the fact that historically in the United States, generally accepted accounting principles tend to be very prescriptive. They tend to have a rule, if you will, for pretty much any financial situation. The Financial Accounting Standards Board, which is the governing body or the governing agency in the United States, has been in existence for about 30 years now. And in that time, they have adopted a new standard about every 2 months, a body of knowledge that's impossible for any accountant to really know. On the other hand, under IFRS, the standards tend to be much more principles-based, much more, if you will, free-flowing, much more allowing the accountant to make decisions as to whatever is in the best interest of the company at the time. One of the discussion points is where ultimately we will end up. Probably somewhere along that spectrum or the continuum, but probably more closer toward principles-based than rules-based. Let me give you 3 examples here as to what the differences perhaps are and will be when we compare financial statements under U.S. GAAP as opposed to under IFRS. If you are at all familiar or have ever even seen a balance sheet in the United States, you'll note the old balance sheet equation, assets equal liabilities plus equity. And assets under U.S. GAAP are issued in order of liquidity. Cash is always the first asset under current assets, accounts receivable, and so forth and so on. Under IFRS, the exact opposite will occur. Current assets appear last under assets. Whether one is better than the other, I don't know, and I'm not wanting to say, but nonetheless, that is one of the differences. On the liability equity side of the balance sheet, under US GAAP, current liabilities appear first. Under IFRS, equity will appear first, then liabilities, with current liabilities ending up last. A second example of a difference has to do with the valuation of inventory. In the United States, there are 4 methods of inventory valuation: specific identification, average cost, first in, first out, and last in, first out. Under IFRS, last in, first out will not be allowed, or is not allowed. Essentially what last in, first out does is it essentially says that the most recently purchased inventory items are costed first. In other words, they become part of cost of goods sold. Assuming periods of inflation, and over time we will always have inflation, what LIFO does is allow a company to expense the most current or the higher priced inventory items. Now, for financial reporting purposes, most companies don't want to do that, but for tax purposes they do, because it would allow them to pay less income tax. A third example has to do with research and development costs. In the United States, R&D costs are expensed, regardless of whether they produce income currently, not at all, or over a 20-year period. Under IFRS, research costs will be expensed or are expensed, where development costs will be capitalized and, if you will, amortized over the useful life, or in other words, the period of time that whatever the item that has been developed will be producing income. Now, none of these appear to be insurmountable, and as I say, I think that by probably 2015 we will convert or at least harmonize toward IFRS, but in spite of the fact that it is somewhat down the road, 3 or 4 or 5 years down the road, accounting students now and accounting professionals are having to learn about IFRS. Thank you very much. I'll take any questions that you have later.